Welcome back to Real Estate Mindset. Today's video is going to be absolutely bonkers. Today is our live morning video. And first, I want to say to each and every one of you that's watching, I appreciate you joining me this morning. And I also want to say great work in the comment section. You guys keep commenting on the videos. I see some of the work you guys are doing, and I'm very proud of you. So keep doing that. Now, today, what we're going to do, guys, is we're going to go over what exactly is going on with interest rates. Our interest rate's going to keep going up. So we're going to do a pretty big deep dive today with, the overall what's going on with interest rates. But before I do that, what I'm going to do is I'm going to start by talking about new home construction because I made a post yesterday, basically essentially showing you guys that the prices of new homes right now are gutted. So they're massively gutted right now. But the thing is, guys, it depends on the metro area. Unfortunately, not every metro area has an abundance of new construction like I do. However, what I'm trying to explain to you guys is new construction will lead the way as far as prices, price declines, and things of that nature. Now, obviously, what I believe is happening right now is the market is finally cooling off, okay? So overall prices will start going down. It hasn't hit every metro area yet. More than likely, just like last year, I believe it will spread. I'm already, again, seeing the price cuts happen in Texas. It's already moved over, and I'll show you guys here in a minute, to Central California. So I'm going to pull up Vitals Market. But the thing is, guys, new construction is an important set of data to review because it's forced selling. No matter the conditions of the market, these new home builders will be forced to sell. And another thing real quick, and I'll jump into all of this real quickly here. I asked myself, where's the inventory going to come from, right? I think it's a fair question to ask, where will the inventory come from? And I just want to break this down for you guys because we will get inventory. That's a guarantee. And there will be forced selling. A lot of people have to understand that forced selling is actually a natural part of the housing market. Unfortunately, if there's forced selling in a housing market that is as toxic as it is right now, that's when people can get into trouble. But listen to me, you guys. When I kind of break down and really meditate on the data and I look at the forced selling, I could tell you guys just between divorce and job relocation, if I take the low conservative number, we're going to have at least 1 million listings of forced selling on the low side of things from divorce and job relo. I'm not even talking about medical. So we got 1,000 listings right there. Okay. Again, they have to sell. All right. Another thing, we have a pretty big problem with STR, short-term rentals. It hasn't melted down yet. And then what I mean by short-term rentals is Airbnb, VRBOs, and things like that. So there are listings there. Again, not in every metro area are they going to have an STR meltdown. But another thing, guys, is look at the new home construction. So not only will we have that normal forced selling in the resale market, but new home construction. So how much inventory you guys think is going to come to the market this year? What, 1.6 million, maybe a million, 1.6 million from new home builders? So what I'm saying is no matter if the resale market, if people are handcuffed, right, the golden handcuff to the low interest rate, despite that, we're still going to get forced selling. We're still going to get it. It happens every single year. The thing is people are still purchasing right now. I believe the reason why they're purchasing right now is because they're falling for one of the biggest scams of 2022 and 2023. And unlike 2008, you guys, the scam in 2008 was loans. So the scam back in the day was I can get a loan to buy real estate. So again, the lie was the loan. If you get money for a loan, you invested in real estate, you're going to become a winner. That was the lie of the past. Right now, what I believe the lie is the actual home ownership part. I think that's the lie right now. I think home ownership right now, not for all the people. I believe there's still some people that are finding deals that work for them, right? That can ride out this whole recession and this whole market. But again, you guys, I just think most people really have this wrong, and I get it. I don't blame them for misunderstanding this. I did the same thing back in 2008, and I was a very good industry professional, and I got blindsided. Foreclosure, repo, you guys know the situation. So it does suck, you guys, but I do want to talk about it because it is important. But again, real estate, this price crashing is localized, and it's so localized. And this is what I'm always trying to tell you with my market analysis. everything is so localized, we got to go to the subdivision, right? So when we actually look at value and comps, we have to go to subdivision to figure out if we have a great deal. The price per square foot can help get us there. And I'm really debating whether or not to like show you guys how appraisal value works. Comment below if you guys want me to do an appraisal like report for you guys. I actually teach how appraisals work. So I'm in charge in Houston in Texas to teach realtors how appraisals work. So I actually love that class. I want to teach you guys how value works. So let me know, comment below if you want to do that. Another thing I'm considering, you all, is doing credit report. Credit reports is something that I really, really love to talk about, obviously, because I lost everything and then kind of built my way back up to having great credit. So comment below. Let me know if you guys want to learn about credit, like literally everything you need to know about credit, and also appraisals, like how are appraisals even getting these values, right? So that's what we'll go over, in the future if you guys want me to. But I'm going to start by, let me jump in to some stuff that I have going on, you guys. So here's why I want to talk about new home prices. Basically, I made a post yesterday. Here it is right here. And I tagged clear value tax. And I tagged Christina Smallhorn, and and I'm not trying to be mean, and I hope you guys don't see that. You guys, I get frustrated, and that's why I tag some of these people. The reason I get frustrated is because if these people are wrong, okay, if clear value tax is wrong, and dude, the ego for the first 40 seconds of that video, geez. And then the same thing with Smallhorn. If these people are wrong, okay, and there are buyers that purchased homes based on what these people are saying, which is basically shaming Crash Bros. Both of these people are shaming us, okay? The reason I have a hard time with that, if they're wrong, people go to their financial ruin, okay? They could be financially ruined. And I know what that's like. So I have an issue with that because I don't want innocent people to fall for the same mistakes. Again, it's up to the consumer to buy. They're signing the dotted line. But I am saying, though, these are huge influencers, and I do not like how they're belittling people. So I made this post, you guys, and here's the thing. This is the median sales price for new homes, and it's tanking. It's absolutely in a gutter. It has not even rebounded. So my thing with these people, claiming their victory lap as far as, oh, this fake news with the housing market crash, how could they say that? How could anyone that feels like they're a responsible professional saying, oh, it was fake, when we have data like this, when we're still in the fourth inning? We still have a inversion of the yield curve. We haven't even gone into recession, and they're belittling people like crazy. The thing is, guys, and here's my issue. If I'm wrong, well, the thing is this, check this out. I don't have to guess what would happen if I'm wrong because I'm walking out what I'm saying. I'm renting myself right now. So what was I wrong about? I was hoping that, in February, we'd find great deals in February. I was wrong. And let me tell you what happened to my life. I just had to readjust. I was disappointed like Vital at first, but I had to readjust. And as a renter, I'm going to tell you guys from the bottom of my heart, I absolutely love my life. And I'm proud of myself for not being part of the plane ride like all these other people. I'm just saying. Now, again, everything is localized, but let's go back into this. Okay. Huge drop in median sales price for new homes. But unfortunately, not every metro area has an abundance of new homes. So what I wanted to do is I wanted to take you guys to Vital Signs area. This is Vital Signs area right here. I'm on Lennar's website. Now, I'm saying that because Vital Signs has been a really big part of the channel. And he's disgruntled right now. And some people get tired of me talking about him, but I don't care. I love the guy. Okay. I'm going to put my heart on my sleeve almost every single time. It gets me in trouble. But look at this, guys. This is Vital Signs area. And again, I think this just happened over the last week. But I go on Lennar, and this is what I'm saying. The new home sales and the price declines will lead resale depending on the market, right? My market is saturated. And I'm going to show you guys that in a minute. But look at this. This is even Vital Signs. And, Vital's saying there's no price cuts, remember? And I'm not picking on you, Vital. But look, dude, like these are huge price cuts, 30. And I know they're junk Lennars, okay? Well, I got to be careful what I say. But I know it's just Lennar, but I'm saying this spreads, brother. Like usually it starts with Lennar. And look at some of these price cuts. And I know it's maybe not that much. It's like 30,000, but 30,000, what is that? 8% price cut. I mean, it's something, right? It's something. And there's 196 homes available, 20 communities. So what I'm saying, man, if you guys are discouraged, do some research. You know what I mean? And if you do research and you're still discouraged, go get an electric scooter and go to the park like I do. I have to get outside. But another thing, you guys, it just, I'm not trying to be mean. I don't want to push people away, especially my viewers, especially the ones that have been supporting me. I just, again, you guys, you have to understand my position. You have to understand my career. Remember where I'm coming from. My career in real estate was helping the bottom of the barrel, per se. And I say that, with empathy, but basically helping the bottom of the barrel of consumers. I have helped thousands of consumers that were struggling get back on track and purchase a home. I was known in my industry as the guy that people went to that didn't turn their back, right? So essentially, I'm helping everyone. I turn my back to no one. So I have that heart for consumers. Plus, I lost everything and I know what that's like, right? Bankruptcy, repo, all of the stuff that I went through. So, you know, it just drives me crazy. The lack of caution drives me crazy. And another thing, again, it's way too soon. I don't understand how they could be belittling us when we have the data like this. Here's the data on median sales price from houses, and this is doing resale. I'm sorry, this is existing and new homes. Okay. Now I understand this is quarter over quarter. I get it. Okay. If we look at month over month, it's not going to show this trajectory. I get that. But we're just looking at quarter over quarter, and we can see there hasn't even been a rebound when we add all of the prices for homes. And I know it takes in new construction. I get it. But nevertheless, this updated Q2 of 2023, you could see that. This is median sales price for houses sold in the US. Now, I understand house values are rebounding. I'm not disputing that, but I am saying it's way too soon for anyone to be really doing a victory lap. We can't even see the data on a quarter, an increase on the quarterly basis. This is crazy. And look at this again, going back to the new home sales. You guys, look at the value decline, never even rebounded. Even though they had insane buying incentives, think about the buying incentives that they're offering. Think about the fact that these new home builders, specifically Lennar, is offering a 4.25% fixed rate, and still the prices are going down. Think about it. And I believe, you guys, the predominant reason, and I'm going to show you my market share. I believe the predominant reason, and there's a question here, that we're seeing price declines even though we have low inventory. Two reasons. One, equity run up. Number two, unaffordability. And we see that in Austin and we see that in Dallas, because I've looked at Texas and I'm like, okay, why are prices going down? So I looked at inventory, job loss, migration. I looked at all of that type of stuff, and it was the leading factors: equity run up and unaffordability. It's leading factors, and that's what we're seeing here. And that's why, you guys, the law of supply and demand are not going to work for very long in this situation. The laws of supply and demand, first of all, incredibly powerful. But the thing is it's not consistent. If the rate stayed 3% and the government continued bailing us out and giving us stimulus, then yes, the laws of supply and demand would run the show. But we're not in a vacuum. Things change. The interest rates, way more than doubled. Things aren't the same anymore. And on top of that, the buying run up was also a result of emotion and recklessness. Anyways, you guys, just saying, but I want to show you the market share. Okay. So what I'm going to do is I'm going to go into my active MLS, and I'm just going to show you guys, because there was some comments like, oh, the market share is so low with new homes. The market share is too low. And that might be true for their metro area. But I want to show you guys can lean on me for real estate information. Okay. You can lean on me to be transparent and forthcoming. So I'm going to open up my MLS and I'm going to show you guys. And really, you guys, so on the bottom left of the screen, do you guys see where it says 5,000 matches right here? Okay. I'm going to lower my picture. So like underneath me is what I want you to pay attention to, because I'm going to show you the total number of units of new construction versus resale. Again, this is my local MLS. You guys have seen this. This is accessing the matrix. So the first thing is let's look at the city of Katy. It's way bigger than Kingwood. All right. So you guys see that active listings. I checked active listings. I typed in Katy. You can't see that. You can kind of see that to the left of me. Let me move my picture. So I typed in Katy, and look at the total amount of listings in Katy is 1,060 active listings. Okay. So again, in Katy, 1,060 active listings. And one of the reasons why I use median sales price on the national average is because I don't have access to MLS in every metro. If I had access to MLS, you guys, I could give you guys insane data reports, but I only have access to basically my local areas. So when we go up here to where it says year built, I can now filter those listings and only look at new homes. So I want to show you guys, we're basically going to go from 1,060 listings. And then when I put the year built 2022 to 2023, Look at the listings, 419 listings. Okay. So again, in Katy, one of my local cities, there are 419 listings that are new homes, which basically represents what? 40% of total listings in Katy are new home construction. So I think it's really fair to look at the new home construction data. Look at 40%. Here's another one. Let's go to Conroe. Okay, and then we're going to get started with interest rates because I got a lot to show you guys as far as interest rates. All right, let me clear the dates out of here. Okay, so take a look at Conroe real quick, you guys. Okay, you can see the total listings right here on the bottom. You guys see that? So in Conroe, the total amount of listings counting new and existing is 1180. All right. But when we just want to see what the new construction is, and again, not all of the new homes are even listed. You guys, I would imagine there's probably another 10% or even more of listings that these new home builders could put on the market. Think of what I'm saying. But look at when I change it to just new homes, look at it goes from what 1180 to 660. I'm sorry, 686. That's what, you guys, that's over 50%, right? That's over 50% of the total listings are new homes. So I hope you guys start to see what I'm trying to show you, which is basically you guys got to do the research in your local market. Real estate is all about being local. I look at the big picture because, I have viewers in California, I have viewers in New York, I have viewers in Texas. So I'm trying to do the best I can to show you what's happening overall. But don't make the mistake and assume that I'm like saying these things with absolute certainty, because there's a but and there's an if, and it's really big. And that but and that if is location. Don't forget that. Okay. But overall, these are the trends. Now, let's go over interest rates. You guys, interest rates right now, holy smokes. And oh my gosh, I just went into the 10-year. Holy smokes, my gosh. Oh my God, you guys. So, and also, as far as the comments, I'm sorry I didn't throw up your comments. But do me a favor, you guys, throw up some comments right here. I'm going to go to the end and I'm going to have a discussion. There's already started a few of your comments, very, very good stuff. And I see here, listen, as far as clear, I say a comment about clear value tax. Like, I'm not trying to beat up the guy. I just think it's extremely reckless to say it's fake news when we have literally multiple data points, not even counting the economic warnings like the inversion and the M2 and like, industrial production and these types of things. It's just reckless, man. It's just reckless. And I was a fan too. But let's start with the 10-year, you guys. We're going to look at the 10-year treasury. Unbelievable what's going on right now. Do you guys think it has to do with the downgraded debt? It's probably a downgrade of our credit, and probably also the treasury trying to fill up their account to spend money. But look at this, guys. This is absolutely shocking, right? Isn't this amazing? So interest rates, residential mortgage rates, 30-year fixed rate mortgage rates track extremely closely to the 10-year treasury. And we watch that 10-year treasury just so we can stay ahead of the curve. And really what I'm trying to do is I'm trying to give you guys like intel, like months ahead of the media. And that's really what I'm trying to do with these videos. Like, you guys should be ahead of most people as far as understanding what's going on. But you guys, the 10-year has skyrocketed. And it ended yesterday, I believe, up 8 basis points. And then the day before that, 10 basis points. And then today it's up 9 basis points. This is a huge, huge movement, you guys. Basically, it's going to hit buying demand. This is going to crush even more buying demand right now. This is insane. I know there's still cash buyers, but guess what? You guys, that cash is running out like crazy. How many cash buyers are there? We can't, like, money is not printed on trees. But yeah, there's cash buyers for sure. But oh my God, let me show you guys. Let's see the last year. And you guys can see we are almost at a peak. The 10-year has not been this high. I don't think it ever hit this entire year, right? Yeah. So we're at the high for the entire year. Last time it was this high, the 10-year was this high, you guys, was all the way back in November of 2022. This is great. Unfortunately, I think we're a little late, right? Obviously, hopefully, we wanted to keep this high because we didn't want to see these people flood back into the market, based on fear of missing out predominantly. But look at that. 4.125 or 4.175, huge movements. Take a look at the interest rates as well, you guys. Here's where we're sitting at as far as interest rates. Now, this was updated yesterday. Not a lot of movement. I actually expected that to go higher. We're probably going to go into the weekend at probably 7.25. Again, it's probably going to update at the end of today at 7.25. We're sitting at 7.13% right now. And I'm going to pull up and show you how much interest that is. But let me show you the charts real quick of interest rates. Why is this huge like this? This is crazy. Sorry about that, guys. Sometimes their charts kind of bug out on me. All right, I guess I won't be doing that. I mean, I wanted to. My heart was there, right? I mean, intentions aren't everything, though. Unfortunately, intentions aren't everything. All right, let me go back into here real quick. So, what I basically wanted to show you is rates are almost as high as they were basically last year. That's what I was going to show you. They're really high right now, and prices are near records. They're not. Prices are going down on average, not in every metro area. Now, I want you guys to think about this. Like, okay, right now as a renter, okay, I'm a renter right now. I don't want to be. I would prefer, for obvious reasons, to own a house, but I'm a renter right now, and I'm okay. I love my life, and I'm saving my money, and I've literally taken my down payment for a house, and I've purchased 1 month treasuries. The 1 month treasury right now, you guys, I don't have it up, but I think it's like at 5.4%. So I've taken my down payment. I've made an account through Treasury Direct. If you guys need to know how to do this, just go on YouTube and watch a video. It'll take you 10 minutes. And I'm literally getting hundreds of dollars back a month just because I've taken my down payment and put it in T-bills. So my life, I actually dude, I love my life. You guys, I love my life. I don't want to be bullied into buying a house, but I also want to make this clear as well. I'm looking every single day, and I will buy a house tomorrow if I find it. I know what I want in this market. I'm looking for my dream home at 2019 prices. And people are like, Travis, there's no way. That's crazy. You guys, I already made an offer. I already found it. I found it. Remember this year in February? Now I went 9% under 2019 values. I didn't get the property. But the thing is I'm okay with waiting longer because my life is great and I'm improving my situation. My situation is not getting worse. That's what I'm trying to tell you. And I think the same thing with some of the people that are watching on the sidelines with Vital. I think maybe the emotions are hard, but I really believe that, Vital, maybe you could tell me, and I want you to call me. I think that you're improving your situation. But anyways, guys, let's see that, let's say we got off of the sidelines and we just went and purchased and we got a 7% interest rate. Let's take a look now. Oh, by the way, I hope you guys noticed in every one of my videos now, my new videos, if you guys go to my description, I have included 4 helpful links. It does not go to me. I get paid absolutely zero money, but it's helpful links. If you guys want to calculate debt to income ratio, how much you can afford, this graph is in there. So go to my description. I set that up because I wanted to give you guys more value, but take a look, you guys. Here's a site from the CFPB. This is a really cool site. Again, it is going to be linked in every description that I have. And this is really showing us at a house price of $410,000 with the down payment at 10%. Our loan amount would be $369,000. Do y'all see that? Now, here's the interest rate range that I put here because it's kind of today's rates. I put 7% to 7.25%. And basically what I want to show you, because we get a lot of bullying like, oh, you're full if you're renting. Well, I mean, look at what people are doing right now when they're buying, if they're getting a loan. Again, some people are making good decisions, okay? But look at you guys, in the first 5 years, I just wanted to point out, first 5 years, you pay back in just interest. This is not principal. This is just interest, $125,000 to $130,000, okay? Back in only interest. You guys can see that right here, $369,000 loan, interest rate range 7 to 7.25, $125,000 to $130,000 in wasted money. Total amount of the interest. And when I see this, y'all, so again, if I get a loan amount for $369,000 and I pay the life of that loan in just interest, $514,000. So I'm okay renting right now, if y'all know what I mean. I'm just saying, I'm okay renting. This will be linked if you guys want to check this out for yourself. Now take a look at this as well. I also have this linked, you guys, as well. I really want to give you guys value. I'm getting so tired of the lack of value I see all over the place. But this is an amortization calculator. And you guys see that I put today's interest rates in there. Do you see that? 7.13%. And I have a loan amount of $369,000. And really what I want to show you is basically if you pay this for 10 years, look at, so you start with 369. After 10 years of payment, you've only paid that down $51,000. After 10 years, oh my gosh, total amount of payments almost $900,000. Y'all see that? So I mean, like, yeah, normally, like, yeah, I don't want to get stuck renting. I don't want to be trapped renting. In fact, I really want to get out of renting as soon as possible because I do not like it. But I just wanted to put things in perspective. This is a ton of money you're wasting in interest. But I also want to say, okay, to be fair, in my own personal situation, I know a lot about taxes. I love numbers. I want to be fair and say that, in my situation, I can tax deduct as long as I exceed my standard deduction. But I can tax deduct the interest. So I can't necessarily do that when I rent. But because I have a home office, I actually can do that because I'm self-employed and I have a Schedule C. Anyways, talk to a CPA. I thought you guys would find that interesting. Again, you guys, the more aware you are about how financing works, the better decision you're going to make. Don't let me do the thinking for you, right? And you guys do what you want, but I just want to make sure you're thinking. I'll be happy if you guys are just thinking, right? Anyways, now we're going to go into some interesting stuff as well. Noel, I appreciate you. I see this super chat. I really appreciate you. I appreciate all your support from the very beginning. Thank you for that. I hope you're doing well. I hope your credit is better. I hope you're saving more money. I hope your mindset is great. And I hope you're becoming an expert. And really, that you know what you want. I'm afraid also, y'all, that people don't know what they want. Like, I don't want people to just sit back and like wait for a house market crash, snap their fingers, okay, it's time to buy. Don't do that. Prepare right now. Understand, what do you want? Like, I have everything like in my mind as far as what I'm looking for, so I can execute. Okay, don't procrastinate is my point. So we're going to do our first video, you guys. This video is cool. This video is crazy. This is going to go into basically the interest cost of the United States. Okay, so this video is basically about treasuries, okay, and securities, and basically that the market is starting to break because they're basically saying that the United States is in too much debt, okay? And also, you guys, essentially, this is also implying that interest rates can basically go up even more. So the reality is we'll probably, there's a high probability, in my opinion, of interest rates hitting 8% this year, and probably within the next couple months. All right, so let's listen to our first video. I forgot to set up my screen. I'm going to do that now. I see some of your guys' comments. I'm going to wait to the end to bring those up. I'm going to share this real quick, guys. This is very, very interesting. It's about 5 minutes. I hope you guys enjoy. And let me know if you guys can that the audio is okay.
Explaining is Dan Clifton, head of policy research at Strategas. It's great to see you, Dan. And listen, everyone seems to be focusing on the fact that we're not going to default because we have the printing press. But that's not the point. We just had another debt ceiling show. I mean, at this point, of course we should expect that this could happen sometime in the future. It keeps coming up time and again.
That's right, Kelly. Let me start off by saying that 2011, investors took it very seriously. Turned out to be a one-time warning shot. People are extrapolating that and trying to compare it to today. We're in a very different environment today than we were in 2011. Then we had low inflation, low interest rates. We actually had significant savings out of the debt ceiling deal. And it was clear the U.S. debt to GDP trajectory was on much better footing. Today is very different. We're in a high interest rate, high inflation, or coming down inflation environment. And what that's doing is it's ballooning the interest cost of the debt. And so now we have a net interest cost that's rising for the first time in 35 years. And when the net interest cost goes up, it begins to squeeze out other domestic spending programs, and investors begin to get worried about what can actually start to get paid back. I get it. We got a printing press with a reserve currency. We can get away with a lot more than other people had that other countries can. But
True.
This is a very significant inflection point we're at. And as you know, Kelly, once you hit 14% of tax revenues for your interest costs, historically, the U.S. has moved into a period of austerity. We're right at that 14% today. Let me just tell you about Janet Yellen. Janet Yellen says when you get to about 3% of GDP in interest costs, you hit the danger zone. We're going to be there by the end of this year. So I tend to view this not as a political event, but as a warning shot that we need to get our fiscal house in order at these level of high interest rates. And if we don't, the Fed is probably going to have to come in here and help the Treasury out to be able to get those interest costs lower, because we are not on a sustainable pattern right now.
Interesting. And think about what this man is saying. So he's basically saying that the Federal Reserve is going to have to bail out the Treasury because interest rates are too high. Interesting.
highlighted this before, that the public in 2011 was much more outraged about the debt and deficit situation,
Absolutely.
which is actually a lot worse today, but seems to be met with a shrug, even though interest rates are higher. What do you think the market is telling us? We saw bond yields jumping yesterday. It was a bit of a head scratcher. The economic data had been, mixed to weak. And yet everyone's starting to focus on the issuance that's coming, especially on the long end. And I'm not sure I'm always persuaded by issuance arguments. I feel like it kind of finds its home based on maybe nominal GDP or whatever, but maybe this time's different.
Yeah, I would argue just look at the gymnastics that Treasury is doing to raise the debt. There's always going to be buyers of Treasury debt. The question is what price you're going to pay. Well, the announcement that was made today is that Treasury is going to spend or they're going to issue another $800 billion of T-bills on top of the previous $1 trillion of T-bills at a 5.4% rate to finance the government operation.
Wow.
They can easily go out on a 10-year and do it at 3.5% rate. They're worried about the liquidity impact. They're worried about bank solvency issues. These are the first signs that there's stress building into the Treasury market.
Wow.
It's just not normal. Now, I'm not predicting an implosion. I'm not predicting that maybe stocks should sell off because of this. But what I'm trying to say is what is happening is very reminiscent of what happens when your net interest cost begins to surge and there are problems bubbling underneath the surface. And so the Republicans are going to see this Fitch rating and they're going to say, oh, we want to hold up on that government funding for October 1st. I think this raises the probability we're likely going to have a government shutdown on October 1st.
Oh, interesting.
And it's going to raise the pressure on the Fed to become more accommodative than they've.
So I don't know if you guys picked that up, but he's saying that he believes there's going to be a government shutdown October 1st. I mean, is anyone surprised that they downgraded the credit of the U.S.? I mean, seriously, is anyone surprised about that? But anyways, this is interesting. I hope you guys understand. He's basically saying he believes that there's massive problems
Been for the last 2 years.
You're absolutely right. It will act to kind of galvanize public attention on this issue, which maybe wasn't there 6 months ago. So most people look at this and go, okay, whatever the Fed does is going to kind of the yields will react. You're kind of making the argument from the other direction. When you look at the yields, you think the Fed might need to start cutting here to help Treasury out. Just explain that.
Yeah, well, I think we'll eventually get there. But clearly, yields have been moving in perfect proportion to the liquidity drain that we've seen since the debt ceiling. So as liquidity has come out, yields have gone up. That's exactly what we would expect. Same thing with the dollar strengthening, so to speak. What's going to happen is that there's going to be a forward look. And if you think about 2011, we raised the debt ceiling 12 years ago today. Today's the 12-year anniversary, which I think is an interesting data point. And what happened was it took maybe 6, 7, 8 weeks before the Fed began to really step in and they started Operation Twist. So that's down the path where you'll start to see it if these problems continue. But today's Treasury quarterly refunding announcement is saying we need more debt and that there's more strains on issuing that debt. That means we're going to have higher yields. That means the interest cost is going to continue to go higher on the federal government. And Congress is basically going to be passing budgets to pay interest. At some point, that's going to be financial markets pressuring austerity, and there's going to be political pressure to begin to change that. The Biden administration would love to wait to deal with this in 2025. Hopefully they can get through to 2025. But my sense here is that there's pressure is going to come a lot sooner than that.
Very interesting. Let me know what you guys think of that. I mean, I think we can all most of us can agree that the government spends way too much money. I think it's interesting also that he's, thinking that there's going to be a shutdown in October. So what I want to do, guys, is, I think that what's going to happen is I think interest rates are just going to continue to go up probably for the next few months. And honestly, this should be a good thing because, again, we need less people to be buying overpriced houses. Again, if people are out there, especially investors, and they're buying and finding great deals, props to them, right? Not every market is going to be the same. I want you guys to understand, I'm not saying that the entire United States of America is crashing right now. But what I am saying is it has started and it hasn't even stopped yet. There has been rebounds as well, and not all the markets are reacting the same way, which is important to know because there is no certainties. There's only probabilities, right? But anyways, you guys, I think it's going to be worse. I think the interest rates are going to go higher. I'm going to read a little bit of this article. I only highlighted a few things. You guys know I hate reading. It is what it is. But with the deficit hitting 1.39 trillion, a sobering 170% increase, traders are bracing for a $102 billion auction of Treasury bonds. This is crazy to me because it's like, I just don't understand how people like we're saying like just refinance later, just refinance later. You can't refinance later if the rate's higher and you have no equity. It makes no sense. What are you going to refinance it to a higher payment? I mean, seriously, this is insane. Listen to what's going on. The U.S. Treasury is set this week to begin a ramp up in issuance of longer dated securities that's likely to stretch, here we go, into next year, forced by a rapidly deteriorating budget deficit and soaring interest rates. And again, like back to the bulls, if the economy is doing so well, then what's up with the trade deficit exploding? What's up with credit card debt exploding? Like, and I understand we are a nation of debt, but what happened to the nation of like responsible Americans? Aren't we that still? I think some of us are. Let's keep reading. For the first time since 2021, the Treasury will boost its so-called quarterly refunding of longer-term treasuries to 102 billion from 96 billion. The consensus among dealers suggests, while down from the record levels hit during the COVID-19 crisis, that's well above pre-pandemic levels. Here's the problem: public borrowing needs are on the rise thanks in part to the Federal Reserve's hikes that have taken its policy benchmark to a 22-year high. Again, 22-year high on interest rates, and yet we have this massive everything asset bubble. It's not going to end well, in my opinion. In turn, driving up yields on government debt, making it more costly. The Fed is also shrinking. Here's the important thing: the Fed is also shrinking its holdings of treasuries. Okay. So again, the Federal Reserve is letting the treasuries that they have mature, and they're not repurchasing. Okay, and the problem with that is that's obligating bigger government sales of them to other buyers like us, and that is going to basically cause the interest rates to go higher to entice us to purchase securities, is what I believe, anyways. And all of these rises the risk of bigger volatility swings when the government auctions its securities. That's just a lot of supply coming. We've been surprised by the deficit numbers, which are sobering. Okay, larger amounts of debt issuance haven't translated directly into lower prices and higher yields, as the swirling in U.S. debt alongside historically low yields attest over the past 2 decades. So understand this, because I see people saying that people are. I see people are saying that Jerome Powell is weak. Okay, and I get it, right? They just bailed out the banks in March, so it would appear that way, but if they didn't bail out the banks, they would have to have reversed their interest rate hikes. So now I'm thinking like, you know what? Maybe Jerome is smart because we've been the last 2 decades of low interest rates. So maybe he's being strong and we just don't know it. I want to believe it. I'm still on the side like, dude, Jerome, you're really upsetting me. But maybe this is a good thing. Maybe the longer that we're in this heightened rate, these rates, maybe the better off we'll be in the future. Think about it. It is possible still. And it's possible because the show's not over yet. We can't necessarily judge everything yet until the show is over and time has gone on. Maybe I'm naive. I'm probably naive. I want to believe. Anyways, what has sent yields higher is Fed rate hikes and inflation, a key dynamic widening the budget deficit. The cost of servicing U.S. government debt jumped by 25% in the first 9 months of the fiscal year, reaching $652 billion, part of the global phenomenon propelling public borrowing. In other words, the debt right now is completely out of control. That's fair to say. I thank you for the super chat. Let me throw the super chat up here. I got some more stuff. We're almost done, you guys. Okay, I asked about a $480,000 house before. So it checks off several boxes. Price is more than I want. In my opinion, depression coming in retrospect. Watching you saved us 6.2% rate is $3,300. 35% income is $2,100. With 20K more income, $2,400 at 35%. So Jack, I asked about. Okay, good. Price is more than I want. I mean, the reality is this, and I really appreciate that support, man. I really do. Jack, I think the thing is this, like, we know that the Federal Reserve is going to lower interest rates. And we also know when they lower interest rates, we're going to have more inventory come and we're going to have more buyer come, right? The thing is, as long as you're prepared right now and you know exactly what you want, by the time the Fed pivots and does lower interest rates, say everyone comes flooding back to the market, it's okay if everyone comes flooding back into the market, so long as you're first in line. Do you see what I'm saying, brother? So if you're first in line, it should be easier for you to be a winner. So I think like my biggest concern, Jack, with people right now is like they're not understanding just how unaffordable the house is, right? However, if someone's making $500,000 a year in salary and their mortgage payment's only $2,000, who cares, right? They may not care. They can write it out for 15 years and they have so much money left over. But it starts to get a huge problem when you're like a lot of your money is going to just your mortgage payment, and it becomes a huge problem if you're in consumer debt and you don't have any money saved, because we're heading into choppy waters. We're in choppy waters right now, and you want to be prepared for uncertainty. And if you're buying right now and you don't have that cushion, that 6 months of reserves, you're still in consumer debt, it's going to be a lot harder for you to hold on during hard times. But again, the better prepared you are, the more likely it is you have a higher probability of being okay. So I don't want anyone to be frozen in fear. I want people to be aware of the probability of hard times, and fight. Prepare yourself accordingly so you can get through it, I guess is really what I'm trying to say. Brother, thank you for that donation. I think affordability is super important right now, but I think it's super important to understand that the affordability is not sustainable. The unaffordability is not sustainable, just like the affordability wasn't sustainable in 2020 and 2021 and certain parts of 2022. So what I'm going to do, y'all, is I'm going to go back to here, and I want to, let's see. I want to talk about this. Where's my picture at? All right. So what I'm going to do now is I'm going to talk about this video. So this video is going to go into existing home sales. Okay, this is really cool, actually. So this is going to go into existing home sales. This is going to be our second video. I'm going to timestamp it. It's a little bit bullish, you guys, but basically going to go into existing home sales, basically being at a near record low due to basically supply and affordability issues. And it's going to go into a little bit more about like the, golden handcuffs per se. And it's also going to go into more about like some people think we're going to have an inventory explosion at the end of this year. So he's going to go into like why he doesn't think we're going to have an inventory explosion. Some pretty interesting opinions here. I hope you guys enjoy it. Let me throw this up here real quick and we will get y'all started. And if you guys can, please let me know the audio is okay. And
Logan, it's good to see you. I follow you on social media all the time. You've been talking a lot about this, so good morning.
Good morning. And yes, mortgage rates are simply too high to create more growth in the housing market right now. Even though demand is no longer collapsing, we're not seeing much growth at all with rates near 7%.
Right. So I want to dig into some of the data that you actually sent us. Let's start off looking at new listings of single family homes. You shared some data comparing this year to last year and also to 2021. It shows inventory well below those years, but still ticking a bit higher year to date. How should we read this trend?
Well, new listings data has been trending at the lowest levels ever recorded in history for the last 12 months. As soon as mortgage rates got above 6%, so there's a certain group of homeowners that just will not move. Simply, they can't afford to move. Also, active listings are now negative year over year. So you combine those two together, you have a very tight supply and you have an affordability issue. And this is the main reason why existing home sales are still near 21st century lows today.
That's crazy. All right, so really interesting. So one of the charts we show, by the way, for the viewers who are trying to watch, the blue line is 2023. So also want to ask you about the U.S. credit rating downgrade from Fitch. Does that impact the housing market, either directly or indirectly?
Well, as of right now, the 10-year yield hasn't made any big noticeable moves as of today. We'll see if the mortgage-backed security market gets stressed any more than it is right now. But I think we all know that everyone knows we're going to have deficits for a very long time every single year. It's how do we deal with a debt ceiling issue if one time we don't actually get that passed at some event in the future? So as of right now, it's not a problem in the bond market. But time will tell, when that issue arises once again, and it'll be here every single year for some time.
All right. So I want to go back to some other data that you gave us, just back to the broader housing market, and give us the right way to read this one. So according to your data, inventory numbers, they spiked on the back end of 2022. Is it possible with so much demand, we could see a similar trend this year, so much demand and also mortgage rates above 7%?
Actually.
I don't see booming housing demand. I see stable housing demand. But when you have stable housing demand and active listings near all-time lows, it doesn't actually allow inventory to grow like it did last year. Last year, we had the biggest one-year sales crash ever. And what occurred is that the slope of the inventory curve was very fast last year. This year, not so much. And that's the main reason why active listings is still negative year over year currently. And new listings data has been trending at the lowest levels ever. Simply put, it's too expensive for a lot of people to move, so a lot of people are just sitting in.
All right, so it's really about affordability.
I do. I'm not a big mortgage rate lockdown or golden handcuff person. I just believe that there's going to be certain Americans that got hit with the affordability crisis of last year, and because of that, you see the new listings data come down. Think of it as this. Supply is a function of demand for housing. So naturally, when there's a huge affordability hit, that supply not coming onto the market is a function of demand being hit rather than people saying, I don't want to move because of my mortgage rate is so low.
Interesting. So, I mean, the interesting perspective. He's saying that the reason for like the low existing, like existing homes, not talking about new construction, because it's like a tale of different worlds, right? Like new construction crashing in most places. But when we talk about existing homes is overall in really bad shape. So I find it very interesting that he's saying the reason for the lack of existing home listings coming on the market is obviously because of unaffordability. It's not necessarily golden handcuffs are being locked in, although they do have a relationship together. Thought that was interesting perspective. But again, you guys, I just want to take us back to the lack of sustainability and the lack of fundamentals, because again, one of the things that I noticed when I researched my own personal state of Texas, I looked at Dallas, San Antonio, Austin, and Houston. And I looked at, again, 6 points of data to try to figure out why was Austin, dropping in prices like crazy. Meanwhile, San Antonio and Houston were more stable, and then yet Dallas was in the middle. So I looked at several different things. And again, I went back to the two main factors at driving the prices down right now from what I reviewed was, again, the equity run up, unsustainable, broken fundamentals, and number two, the massive unaffordability. And I think that those are, again, you guys, I think if we really pay attention to equity run up and how unaffordable things are, though in the worst shape those metro areas are in, the more the price crash will happen. So let me show you a map of that. And I think we can see that in this map. Let me zoom in. This is a really cool map that Black Knight started doing. Really love this map. And basically, this is the payment to income ratio difference from the benchmark. So it's saying how unaffordable it is, right? So like say normally your benchmark is like 25% of your income going to your mortgage, right? So this is like over that, like how much over that? And, one of the things that we see immediately when we look at this information is we see how unaffordable the West Coast is. I mean, look at some of this, 32% above benchmark, which means that's 32% higher in unaffordability than typical. And I believe you guys, when we look at the West Coast, we know that on the West Coast, it got gutted on the West Coast. It has rebounded, for the last maybe 3 months, but it got gutted. And if we look at the unaffordability, it's easy to see why. Do y'all follow me here? And look at this, same thing here. Okay, with Phoenix, same thing with Las Vegas. Look at it. It's one of the most unaffordable places to live as far as the benchmark, and it has the highest price declines. So do y'all see what I'm saying? So I understand supply and demand is important, but when things don't remain consistent and there's misinformation like home values will only go up, interest rates are about to go down, the thing's going to break apart. Then it's not just supply and demand loss. Do y'all understand what I'm saying? So very interesting to note that. And again, like this area right here, you guys, like this was like Jeff's area. And remember, Jeff was always like, man, I can't find anything. One of the reasons why this area right here is not seeing price decline like we have on the West Coast and then places in Texas is because the affordability is relatively, okay, I'm just saying like relatively still there. So this is like, I think we're looking at the wrong things. Like the inventory is important. I'm not saying the inventory is not important. The inventory is vital, but the unaffordability is more powerful. That's the point I'm trying to make, because it's the unaffordability now that's manipulating the laws of supply and demand. Do y'all understand? So the unaffordability is stronger, and that is the inconsistency within the laws of supply and demand. Again, if rates stay 2-3%, the Fed kept giving us stimulus, then yeah, supply and demand is going to take over for the rest of our lives, but it's not consistent. It is different now. So very, very intriguing map here. And I also wanted to point out, like, look at Florida. Florida's going to get there, and we've already seen it soften in Florida. It was interesting. It went against the trends all of like last year in 2022, and then started softening when most other places started rebounding. Very interesting. But again, you're going to see it in Florida, because look at the unaffordability. Based on my calculations, the unaffordability will take prices down alone, even in the face of massive migration. All right. So again, and I'm saying that because migration in Florida is ridiculous, and also migration here in Texas is also ridiculous. But that's everything, you guys. I'm going to pull up some comments and see if we can have some good talks. I hope you guys enjoyed the interest rate and new construction little breakdown I have. So I want to pull up some comments now that I thought were some good comments that maybe would strike some good conversation. Now, the first one's from my man from Vital. Why is my focus like that? Okay. Sorry. So this is how capitalism should work. You know, my brother and I were discussing due to rate lock. I think this is due to rate lock. Many that get laid off may never become forced sellers due to high rent. So I wanted to talk about that because it depends on when they purchased. So if people purchase like prior to 2022, it might be hard if they lose their job. It may be hard for them to sell unless they move back in with family. But the other thing, Vital, like if they just lost their job, I think one thing that you have to consider is they may sell their house to cash in on the $100,000, $200,000 in equity. If you just lost your job and you can cash in $100,000, $200,000, I'm pretty sure that some people will take that opportunity. However, you bring up a good point. But the thing is, again, remember, anyone that's purchasing basically from an equity standpoint only, 2022 and on is not in that situation. Remember that 2022 and on, they're taking the full hit. Not only do they have the high prices, they also have the high interest rates. So they're taking the full hit of this. So I want to be clear, tale of two cities here. So far until obviously those distressed buyers go up. Now let's look at this real quick. This is from my dude, Don't Move to Texas. Me and my wife are going crazy in this condo. I think we might go ahead and pull the trigger and move to a rental home on a 1-year lease and reevaluate after next spring. And I don't think that's a bad idea. Don't Move. And I'm making a point to say that I don't think that we should necessarily time the bottom of the market, especially when it comes to our primary residence. Maybe if we want to invest in real estate, we can. But I don't think we should time the bottom of the market. Don't Move. But I definitely don't think that we should rush purchasing a house in this environment right now, especially when we live in Texas and we see these signs. So I think it's okay to rent. But I'll say this, like for me, if I extend my rental lease one more year and I find a house that I love, dude, I'll just break my lease. I'll just take the hit. It's going to be maybe $3,000-$4,000. But if I find my dream home, I'm going to break this lease so fast, you guys. I'm going to be out of here so fast. So I think it's okay to rent, but I get worried sometimes, brother. Like, I don't want people to think they can rent and then just bury their heads in the sand. If you're going to rent, make like triple extra sure that you're working on all of your goals, your credit, your income, your assets, and that you know what you want. Because remember, Don't Move. I know exactly what I want. So I can execute. Do you know what I'm saying? So long as you know what you want and you're increasing your purchasing power and you know that you don't want to rent for too long, brother, I say you go do it and don't get bullied into purchasing. Good question, man. Okay, another question from Living in Omaha. By the way, brother, Living in Omaha, you offended some of my viewers because you were too bullish about the housing market. I just want to let you know that. So tone down a little bit, but I want to also tell you, man, I really appreciate your questions. You have some really amazing questions, and he sticks with us in our community. He's a realtor, and you guys know I talk pretty harshly on some realtors. So props to you, my man. Now, his question is, but also stop anyways, I want you to speak your opinion. Let me just say that, okay? I appreciate everyone. Question: if demand remains depressed and supply remains low, could that just stabilize the market and keep prices flat? So if demand, so basically, if everything stays the same right here, the thing is living in Omaha, there's no certainties. Everything is a probability. So yeah, it can be flat, and it also really greatly depends on the market, and it depends on what's happening in that market. But again, I want to go back to this. I think right now, and this is very interesting. Again, this is from Texas, my research in Texas. I think the main factors right now, sir, is the unaffordability and the equity run up. Okay, I think that, and we see that again. I showed you that map. I think that's going to supersede the lack of inventory. And again, what I'm suspecting that's going to happen as we're moving forward is the lack of toxic home buying demand is going to cause those prices to fall, because when there's nothing propping it up like emotional toxic buying, I believe it's going to fall. And I believe how we're going to know how much it's going to fall as far as prices overall on average is a recession. I think but back to your point, if we don't go into recession somehow, then I think that there will be many metro areas, to into your question, that will be sideways for a long time, maybe 3-4 years. So I really think like the recession and the unemployment, I really think that's going to govern the direction of the prices. I think that's going to be one catalyst for sure. Hopefully I answered that question okay. All right, Scarlett, how are you? Good morning, Scarlett. The goal is to get out of credit card debt. It crippled your money potential and buying power. And I wanted to say, Scarlett's absolutely right. You guys, consumer credit card debt especially cripples your purchasing power. That's why I'm constantly telling people, like, get out of your consumer debt first and then go think about buying a house, right? But, I'll have to say this, as a professional in this industry of over 20 years, helping thousands, literally, I'm not joking, thousands of first-time home buyers, I got to tell you guys, almost 90% of people that come to me asking for help, drowning in credit card debt. Almost every single time. And if you're one of those people, if you're on the sidelines because you don't have, your credit is bad and you feel like you're drowning, this is what I have to tell you, okay? It's okay. You could still get out of debt. One of the best things you could do is stay encouraged, first of all. Number 2, stop the bad from happening. No more late payments, no more using them recklessly. And number 3, start paying them off from the bottom up. All right. And that's going to help your credit. I should do a credit report video. I need to do the credit report video. Okay, one more comment here. We got 2 more comments. Cash is about to gain 25 to 30% in its value back over the next 1.5 years. Nothing beats a 30% return going into recession. Sell everything and hold cash. I mean, do I even need to go into this comment? You know what I mean? What have I been saying this whole time? I mean, what is the purpose of my channel? What is the purpose of my channel if you guys aren't doing what this man is saying? Save your money for the love of all that's holy. I mean, think about it. If we have job loss at the same time as credit crunch, money is going to be hard to come by. So if you're saving your money right now and you go into this recession with money, the probability of you becoming a winner is greatly enhanced. I'm just saying, okay? All right, here's one more from Jack. Jack, I appreciate your comment, man. Travis, do you think home builders will be forced to lower prices soon? 6-ish months. Jack, they're already forced to lower their prices right now. The question is when will it spread to your metro area, and will it spread to your metro area? In metro areas that are heavy in new construction, the price cuts are already there. I mean, I even showed you Central California, and I didn't even know Central California had price cuts. We could go to Austin, we could go to San Antonio, we could go to Houston. The price cuts are happening right now with new home builds. However, that's my market. The question, Jack, is that happening in your market? How do you know that? You research. Where do you start when you research? Where I start with Lennar. Why do I start with Lennar? Is because generally what I've noticed is Lennar leads the new home construction and new home builders with price cuts. So that's why I'm always going to their map. I'm like, okay, if there's price cuts, it's probably going to spread over to new builders. So they're already forced to drop their prices. And let me explain, Jack, why that is. Because there's a reason why they're lowering prices. They have to sell. So no matter what happens, they have to sell. Builders will all basically, because of the way that things work, their financing and their debt obligations will always be forced to sell. That's the point I was trying to make at the beginning of this video. We'll always have forced selling. The thing is the buyers are so toxic, they're just picking that up. They're just buying it. But there's going to be forced selling, man, from these builders. And I suspect just from new construction, 1.5 million units forced selling per given year. And as far as existing homes, I suspect 1 million to 1.5 million forced sales with existing inventory when we look at getting divorce and job relocation. And I'm taking conservative numbers there. So it's already started, man. I think that, but the other thing is this, you have to understand, it doesn't hit every metro area because not every metro area has an abundance of new construction like I have. I showed you guys that in multiple cities around where I live, 40%, 50% of total listings new construction. So in areas like that, we're in great shape, okay? But in areas like Jeff, subscriber who bought, in areas like him, one of the first things that I asked Jeff when I first reviewed his market was, let's look at new construction. That was the first thing. It's horrible. Okay. So there's two things that really come into play here. Number one is location. Okay. Number two is the personalization. What do you personally want? Right? Because the reality is, if people are a little bit more flexible with where they want to live, a lot of people could probably afford a lot more house. So there's personalization in purchasing. I'm not saying settle. I'm saying maybe move 10 miles away and the home will be half the price. I don't know. I'm just saying something like that. But other than that, you guys, I really appreciate you. We're going to end this video. Now, again, do me a favor, you guys, after this, want to end this, if you can, comment. Let me know if you guys want to learn about appraisals. I can literally pull up an appraisal report. I can show you how appraisers calculate appraisal value. Let me know if you guys want that. And also let me know if you want the credit report, where I'll pull up a live credit report and I'll go over like each trade line installments, revolving debt, and I'll show you guys basically like what happens if you're late, and then like what happens if you get co-authorized, and then like what happens if you max out your credit card. So I really like these classes, you guys. I have a huge heart for for training people. And I get motivated training people when I know you're learning. If no one's learning, it's just really hard to keep going. But anyways, you guys, I really love you. I hope you have a great day. Good. I got an appraisal. Good. I really love talking about appraisals. That's one of my favorite things to teach about because it has to do with value. And there's not as much emotion in it. It's just like numbers. But anyways, guys, you have a great Thursday. Have a great weekend. I really appreciate you. Don't forget to comment on the videos. You guys are doing an outstanding job on your comments. I apologize for being a little bit emotional when it comes to these other content creators, y'all. I'm not trying to be a bully. I'm not trying to be a bad person. It's just, I know what happens if they're wrong, because it happened to me. And that's all I'm saying. And other than that, you guys, if you're out there investing in real estate, you already know I wish you luck and I hope you